Why 52 people come to work every day in Melbourne and Sydney is solely to help all Australians reach their financial goals. And we want to do that through technology. So we're not going after simply high net worths, we're going after all Australians. We believe that there is a real problem with financial literacy in Australia. We believe that problem is pretty much around asset allocation. And what we're trying to do is bring together three separate parts of the puzzle which we believe give sort of automated investment advice. One of those is research and advice, and research and advice is over Eureka and Intelligent Investor. Intelligent Investor we bought in 2015. I mean, these guys are amazing. It's a team of 10 analysts, different to pretty much any other investment newsletter in the country and probably in the world. These guys get independently audited every year. So they've been independently audited by Grant Thornton since 2001. And those guys show that over 15 years, now 16 years, we've outperformed the All Ordinaries by 5% year on year, every year. Remember, this is through the GFC, through Brexit, through the Greek debt crisis. I mean, through everything. These guys have seemed to be able to maintain these returns. We bought Eureka Report because when you're trying to automate the investment planning process, you also need somebody to talk about the wider sort of wealth stuff, how to run an SMSF, why auto-rebalancing or why rebalancing your portfolio and asset allocation are important. And so we bought Eureka Report last year. So what I want to show you in a few slides is sort of like what we've been doing with the InvestSMART website for those of you that haven't visited recently. So our ethos is really simple. Apart from offering all these tools and services, our ethos is diversification. It's number one. So for us, we believe that is a framework that we can use across asset classes and also the Intelligent Investor guys use within asset classes. We believe in lower fees, and we believe we can bring the fees down even lower on our sort of model portfolios. So for those of you invested in the portfolios last year, they were about 97 basis points. We brought that down to 77 basis points. And I think as we get more scale, we'll be able to bring those prices down even further and pass them on to our members. We believe in transparency. Everything we do, we show you. There is nobody else in the country, you find me a fund manager that shows you exactly what's in your portfolio and exactly why you buy and sell a share. So we use SMAs, and we use those SMAs and we show you every single stock in the SMA, in the portfolio. You can click on that company and you can see the thesis behind why we're buying, selling or holding those stocks. So basically think of an SMA or our investment portfolio. It's like a managed fund, but basically our products are based on a discretionary management of a portfolio of stocks on your behalf, and that's how we do it. So what I wanted to do is, this is sort of like our SMART sort of idea where we use our portfolio manager. So InvestSMART has always been the sort of tools. The portfolio manager is at the heart of our tools. We're about to bring in international shares into the portfolio manager. So those of you who have been sending us emails for the last 2 years asking for international shares, I believe that's in testing now, so we're covering 7 markets. You can pretty much put in anything to the portfolio manager, all shares, all managed funds. It tracks everything for you. We believe in asset allocation, so we provide the tools to show you what your overall asset allocation is in every asset class. So we look through every security in your portfolio. So just because it looks and smells like an Australian equities, it might be an A-REIT, we know that's property. You might have Magellan, we know that's international equities. You might have a managed fund. We look through that managed fund and we know what portions of what is in which asset classes. We'll talk about rebalancing. We believe rebalancing is really important, though. You don't have to rebalance every day or every month. I'll show you over 20 years you could rebalance over only 4 times and improve your average returns by about 1%. We've added all these tools for you. So on the left-hand side, we call it Member Essentials. It's pretty much the free tools. On the right-hand side, everything you now get on Intelligent Investor is in InvestSMART website, and the menu, we've kept a very similar sort of menu structure that you're used to in Intelligent Investor. On the left-hand side, we've produced a lot of tools where you can go into share, find any shares, you can see all the financials on those shares, you can see if we're researching those shares, that share. You can see whether there's buying or selling in director interest, which we believe is a key indicator of what management thinks of their own company. You can have a look up managed funds. You can have a look up exchange-traded funds. So we know that we've just put out an exchange-traded fund report. For those of you who haven't seen it, it's looking at the whole industry. Exchange-traded funds are going, are booming at the moment. And not every exchange-traded fund is like each other. So We did a report, and we've done our own sort of star rating on what we believe is a good exchange-traded fund compared to another. But you could go down sort of like, for example, and go, I want to find anything in Australia or, you know, emerging markets, and you can go and find, you know, all the ETFs that are in emerging markets, for example, and then our star rating. And our star rating is based on liquidity, and then you can go into these sort of companies and find out exactly what they're investing in, what their underlying, or their top 10 underlying stocks are. It's a really deep website. I mean, it's quite amazing of what we've been able to bring together now, and all those tools are available for all members. You can now track all your performance. You can track that against benchmarks. You can track that against your goals. On the left-hand side, we believe that's a fairly good process. So goals, setting goals, providing a health check, looking at your performance against those goals and against the benchmark, current holdings, and research form the basis of automated investment advice. But we believe there are a lot of people who don't have access to financial planners because of the cost, or don't want to use a financial planner, and so we've provided these services online to deal with many. Now, the whole idea of the health check is not to get to 100%. Yes, I mean, as soon as you get to 100% though, the next day you will be 99%, because all of the time your prices, your equities, your securities are changing in price. They're going up and down. It's dynamic. The funds you're invested in, the fund manager of those funds may be changing their allocation. We may be tweaking our target a little bit, and I'll show you that in a minute. So what we're doing here is, when you set your goals, we're setting you as a growth member or a balanced sort of member or a conservative. We've got our target asset allocation for that sort of risk profile, and we're comparing that against your portfolio and showing where you're under or overexposed. So what I always talk about is, if in 2001, for example, you went along to a financial planner, the financial planner said you're a balanced type person. They gave you a set of investments that gave you that balanced growth profile, that balanced profile. If over the next 7 years you didn't do one thing, by 2007, 2008, you would have had a high growth portfolio. The GFC hit, you would have lost half your money. That's what not rebalancing does, and that's what happens if you get too overexposed to an asset class and don't do anything about it. And that's all that this health check is meant to do. It's just meant to alert you to the idea that you may be overexposed to a given asset class. And now we take security and privacy very, very strongly in InvestSMART. So we don't look at your personal information, we aggregate this information. And on the left-hand side is our members' conservative portfolio. There's about 10,000 people that say that they're conservative, and they are not conservative compared to what we believe is their target on the right-hand side. We've been moving out of cash, and we've been moving into fixed interest and predominantly floating rate notes, and also into global infrastructure. And the reason why we're doing that is we believe there's more there's more risk of interest rates going up than going down, and so we're taking a bit of a sort of like a hedge against that. Here's the growth members. So we have about 40,000 members that say they're growth, and now you can really see that axe, two blades, property and Australian equities. And you can see us on the right-hand side, where we're much more diversified and much more into international equities. So 46% of investors claim to be diversified. They have 2.7 securities. 40% of people said they weren't diversified and they only had 1.6 securities. So why is asset allocation really important? These guys won a Nobel Prize in 1990. It's called modern portfolio theory, and basically what they came out with was they put a mathematical framework around what our forebears have been telling us for 100 years: don't put all your eggs in one basket. So they basically said you can add a security to your portfolio that's not correlated, that's not similar, so add cash to equity, and you can decrease your risk without really sacrificing returns. How does it work? So if we have a look at on the left-hand side is all of our diversified portfolios. So we've benchmarked them against different things, so you can see conservative, moderate, balanced growth and high growth. And on the right-hand side is sector-specific: cash, fixed interest, property, international and Aussie equities. So in the last year, international equities have been the best performing asset class. If we have a look, when I did this in April, it was Australian equities. So what I'm trying to demonstrate here is that each asset class doesn't behave exactly the same as each other asset class. And so having a mix of all 5 of them gives you a better chance, a better return, less volatility. If we have a look at 2 years, 2 years was Australian equities. 2 years, when I did it back in May, was property. If I have a look at 10 years, and as I go out longer and longer, but I didn't want to bore you with lots of slides, you can see now that the left-hand side, the diversified portfolios, have come up to similar returns to the right-hand asset classes. And that's the whole idea of asset allocation. I rebalanced in 2001. In 2006, I was taking money out of Aussie equity, hypothetically this is. I was taking money out of Aussie equities and international equities and putting it into cash and fixed interest because I got overweight in those classes. It then kept on going. Remember, the market kept on going again into 2007. I had to take more away. And then in 2012, it went back the other way, and I rebalanced back the other way. By doing that 4 times in 20 years, I increased my CGAR from 7.64 to 8.39%. The reason why you don't want to rebalance all the time and you need to sort of weigh up the pros and cons is transactional costs. It's going to cost you money to rebalance all the time. So you don't need to do it all the time. You need to do it when you become uncomfortable with your overexposed asset class, whichever asset class that may be. So on the left-hand side, we have a couple of diversified portfolios. They're really for newbies. They're really for people that don't have an existing portfolio and just want to get started. Those diversified portfolios are all ETFs, so we use ETFs. So our core competency, we believe we're very strong in Australian equities. So as Warren Buffett says, if you're outside of your circle of competency, use broad-based indices. That's what we do. So for Australian equities, we believe we've got an advantage on most people because of our knowledge and our core competency, and our track record sort of attests to that. But for international markets and fixed interest and property, we use ETFs. But we actively manage the asset allocation, but we use ETFs to give us the exposure to whichever asset class and the weightings we're looking for. Along the top, we've got asset class specific portfolios. So we've got interest rate, fixed interest, international equities, property and hybrid income. So for example, international equities, we're overweight Europe at the moment, underweight underweight emerging markets, and we balance that against what we believe internally we're doing. And then we've got the 3 along the bottom, which is the equity income, equity growth, and small companies. What are we about? We're about providing low-cost products that are transparent, that help you plug your gaps. So if you find you're underexposed by an asset class like international equities, then we provide products that allow you to simply and easily fill that gap. We always track ourselves against our benchmark, which we use the multi-sector growth benchmark. We are really good at data. We bring in data from everywhere, as you can see if you go to InvestSMART and use some of those filtering tools. We believe over the very long term, we will underperform our benchmark by the fees. That's why we've got to get them down lower. And we'll outperform our peers by the differential in our fees. So at the moment, you can see, and this has only been going for 3 years, but it seems to be working. The average peer fees are 1.8%, and we're 77, and we're pretty much beating them by about 1%. We're not swinging for the fences. We're not a new fund manager that's going out and trying to get massive returns and risk your money. We're trying to just beat our peers and match our index. And we believe over the long term that that's a much better way for people to reach their financial goals. So as we said, set achievable goals. That's important. Manage and research. Assess and diversify. Hopefully you can use the health check to do that. It's a free tool. Rebalance from time to time, weighing up the pros and cons of costs, and track to stay on course. Thank you very much.